All right, I hope this is working. I'm going to ask a friend of mine. All right, am I live? Because this is my first event, and I'm hoping this works. But this is because this is my first event, I don't actually know. There's no feedback. So I can't actually tell if people are seeing me or not. I'm going to assume that they are, and hope everyone is. But I can't actually tell whether or not anyone's actually paying attention. So let me just make sure that we are recording these. Okay, it says recordings disabled while okay, all right. I don't know. I'm going to hope that this is going to record. Okay. Since this is my first event, we're just going to do the best we can. And I understand that I generally give quite a lot of information during these, so I'm going to try and simplify as much as possible, and hope that I don't overwhelm anyone with information. If I do, obviously, please contact me and let me know that you need clarification on something. You're always welcome to comment. You know, I think I can see the comments here. Again, you know, this is my first LinkedIn event. I've done a lot of these on X and other platforms, but I haven't done them here. So it's learning curve. Please, you know, be patient, and hopefully everyone is able to get on this and see what's happening here. Okay, so let's get speaking on this. First, my name is Alexandra Damsker. I'm a former SEC attorney. I've been in blockchain since 2016. I've been in AI and quantum computing since 2019 because they're all, you know, merging together. I worked at a large firm. I founded a couple of companies. I've actually exited. I've been in quite a lot of different things. But I've actually written a book on DeFi and finance for O'Reilly. And it's called Understanding DeFi, and it came out in 2024. And right now I am Chief Legal Officer for Populous, which is a tech company that does two main things, which is build community for elites, because it's actually very hard to find community when you're an elite. And the other thing is using technology and compliance. We're actually building liquidity for a lot of illiquid assets. So those are the two main things that we do, and it's a really fun company. It's very exciting, and let's move on to why we're here. Okay, we're going to talk about the Clarity Act. If you're interested in what the Clarity Act is and what it does, I actually have a very detailed discussion of it. I believe it's still on my profile on X, which is Alex Damsker, and you can actually hear a breakdown of the Clarity Act. I usually go through new laws as they come through and their implications. That breakdown should still be on my X profile. I also have a newsletter where I go through a lot of this stuff, and that is the Damsker Report on Substack. Okay. So what's happened here is the Clarity Act primarily is talking about what the regulatory structure is supposed to be for crypto. And this has been a long, long road. Remember that it actually started under Biden. We had this presidential working group that put out 8 papers basically that went to Treasury, and nothing happened with them, right? There were 0 crypto people in that presidential working group, and nothing came of it. And an infrastructure bill was actually held up until structure was put out for crypto, and nothing happened with that either. So that's the history of this. And now we have the Clarity Act. There are actually several competing bills at the same time, including things like the Parity Act and other bills. We're not talking about those here. What we're going to talk about is the Clarity Act that passed already through the House, and that discussion and that makeup, again, is what was discussed on X. But the the discussion that that we haven't actually talked about is now what's happening in the Senate. So it's been a long road to get to the Senate, and the issue right now is what's happening in the Senate. And we've got a lot happening in the Senate. What you need to know first is that the amendments that we're going to talk about are the ones that came from the Senate Banking Committee. We haven't even gotten to the ones from the Ag Committee. The Senate Ag Committee amendments were supposed to come January 27th, but it looks like they're now coming the 29th. And those are completely different from the amendments we're going to talk about right now. So the House regulatory system was mostly focused on let's make this functioning financial system, right? So we have to think about where this bill was derived from and how it moved, and most of it actually came from the Ag Committee. And we talked about how this bill originated and how most of it was pushed through with the help of the CFTC and not the SEC, which is why it's so heavily reliant on the CFTC as opposed to the SEC. It's predominantly regulated by CFTC action rather than the SEC. Here's a point on that, is that the CFTC, in order to do everything that is prescribed in that bill, right, to take over that regulatory movement that that is no longer under the heading of the SEC, just note that they would need $4 billion in order to do that. So it really is actually shifting everything from the SEC into the CFTC and turning the CFTC from a very small regulatory agency where things pass through relatively easily because there is not much of an agency there, like there's not many layers, and turning it into a much larger agency, right? There's the need for a lot more people, a lot more structure. And I don't think that that is really what people anticipated. There's a reason why the CFTC was like, hey, we'll do it. And, you know, we're going to need a lot more funding. We're going to need a lot more people. And the CFTC becomes fundamentally something much, much larger and more substantial than it was under, this under the current structure. So just know that to do everything that it is supposed to do, the CFTC fundamentally becomes a second SEC. So just keep that in mind. Now, a little note on my personal biases. I try very hard to keep these as politic and bias free as possible. I'm very aware of my own biases, but it's very hard to keep note of all of your biases. One is I am personally not a huge fan of banks. I find it offensive that they charge you to use your money and make a profit off of it. But I'm aware that they have a function in society. I'm very familiar with how the Fed and distribution system works. I talk about it a lot. Finance and economics is a discussion that I have regularly. But I just want to point out that that is the perspective that I come from, in case anyone notes my own discussion or how I speak about banks. You should note that so that you can take your own perspective in mind, like, oh, by the way, oh, she hates banks, so I should probably account for that in how I listen to her, right? So just note that. The second thing is, even though I worked for 3 different government agencies, I have a very I'm not a all regulation works kind of person. I actually think most of the regulation for crypto comes from a very wrong perspective, because fundamentally tokens are shifting assets. All regulatory agencies right now have had to deal with one major thing, which is that that all assets are essentially the same thing from birth to death. Fiat, stocks, bonds, treasuries, everything fundamentally is static. It stays the same thing from birth to death. But Tokens are something different. They can be 7 different things, and they can be different things in the same holder, between holders. They shift, right? So, and often you don't know how you spent a token until after an accountant has applied your local accounting requirement, right? Like first in, first out, whatever it is, to whatever it is that you've spent, to know what it is how you spent that particular token, to know whether it was like a transactional fee or whether it was a product or whatever it is. Like you don't know what that particular token in your hand actually was, particularly for mature tokens, right? So, so your state of mind isn't necessarily relevant for tokens, and state of mind and things like that are all very relevant for the static regulatory system. So fundamentally, all of these things are, in my opinion, super flawed because they don't account for the fact that tokens can be many different things to many different people, can be used in many different ways, whatever the intention of the user, and all of these have the wrong premise. So, you know, fundamentally, for the current regulatory system to work correctly, all of the different regulatory agencies that have any impact have to go to each blockchain after a transaction has occurred and say, this one's yours, that one's mine, this one's yours. And that's like 100 million transactions a day. And that's really inefficient and ineffective. And to me, all of that makes no sense. So, so my perspective is that most of these regulatory processes that we have right now, and most of the premises on our new bills are fundamentally incorrect, and they're being drafted by people who probably don't understand fundamentally how tokens work, what blockchain is, and you know, they think that things like, you know, Ethereum is a computer, and it's not. You know, they think, you know, they have incorrect notions that they've heard from maybe influencers rather than really fundamentally understanding this back-end technology and how these things work. And so I think there's a fundamental problem with all of these, and that they're not going to grow well. Most of these are not going to grow well. Also, as quantum computing comes more online, we are going to have more and more things that can become dynamic assets. And this is going to be something that we need to solve now, because more assets are going to be able to come in and out of different regulatory agencies, depending on who is using them, how they're using it, and when. Right. So, so I think this is a really pressing, pertinent problem that no one's really addressing. So those are the two main biases that I come at this analysis. So just keep that in mind. If you don't agree or you have a different perspective, you can offset what I'm saying with your own perspective. But I'm just trying to be upfront with how I'm viewing these, and I'm trying to remove that as I look at these. But I just want to keep that in mind because it does color the things that I see and say. Okay, so getting back to this, the Senate did come out on the 12th with a bunch of different amendments, and there were like 75 amendments. But we can kind of compile them into a few different categories and talk about what the Senate right now, from the banking perspective, is looking at in terms of the Clarity Act, and why bankers and exchanges led by Coinbase, right? So it's not just Coinbase, right? It's bankers led by Coinbase, why these groups really have a problem with the way that the Senate Banking Committee is really looking at this. So we have these two big issues that are going on from the Senate banking side, and how we think this is going to be resolved, right? And that's before we throw in this other monkey wrench that's going to come out from the Ag Committee, where they're going to go back and say, oh no, we need to go, you know, like look at this other angle that's going to come out again. So it's going to get even more interesting. Okay. So let's look at these amendments. So the first group is, they call them like responsible securities innovation, but really what we're talking about here is this is a group of issues where what what the banking group wants to do is put our system more in alignment with FATF, the Financial Action Task Force, which is this international body that has about 200 countries that are either observers or members. We're one of the members, and for the most part, this international body, right? It looks at all sorts of things like financial crime, financial movement across borders, and things like that, and tries to deal with issues of money that impact all the countries, right? And one of the issues that they have to deal with is financial crime and cross-border transactions, money laundering, and things like that. So one of the big issues has obviously been in crypto transactions, Bitcoin, and money laundering, and these anonymous transactions that have occurred, right? So they had a recommendation that came out, I think, in 2021. That first was a recommendation that everybody start putting basically a compliance with what we had, which was the Bank Secrecy Act, right? Which essentially said you have to not just know your customer, but you also have to know, who is giving you money, right? When you're a bank or when you're dealing with money, you have to know who's giving you money, but you also have to know where that money is from. Right. So you have to have a reasonable idea of, that's the AML, anti-money laundering. You have to have a reasonable idea of where that money is from so that you are not laundering money. And that gets into this issue of anonymity in transactions that is kind of foundational for blockchain. So we like anonymity, but the issue of money laundering is real. And there's this recommendation that later became a requirement on all member countries saying you must enact these rules in some way. You have to find some way to add these regulations that make anybody doing cross-border transactions list the KYC AML requirements, right? Know your customer, know who is giving you money, know where the money is from. You can't be part of this cross-border money cleaning transactional issue, right? Because now crypto is a big part of it. So anybody who is dealing with crypto stuff has to actually start dealing with this. So, and the countries have been stalling, but then the first big law that was passed was MiCA, which was in the EU, right? Which said, okay, now exchanges, you got to start dealing with all of this anti-money laundering stuff. You've got to start listing all your names and all that stuff. And you have to know who's dealing with all of your with the crypto. When you're converting fiat to crypto, you've got to start capturing who these people are. And there's a whole set of language that you have to use, which you may have heard, called VASPs, digital assets and things like that. Everything is supposed to transform into financial assets versus securities assets, and all of these things. Again, I've done a full conversation on this. I've spoken internationally and talked at Web Summit about it. You can catch probably any of that somewhere on the web or maybe on my X profile. It's somewhere, right? There's all that stuff. And it's also in my book. So if you really want a detailed breakdown of that stuff, I have a very clear breakdown of how it impacts crypto. And it has been sitting on the desk of Treasury for several years now. Now, the banking committee definitely wants this stuff incorporated into crypto. That's the goal of this. That's a long roundabout way of saying, here's the goal here, is that we're clearly trying to start incorporating this language, this concept into crypto, which is, let's start talking about how we can actually make ourselves more compliant. They're using things like ancillary assets and stuff like that, but they're starting to use this idea of how do we incorporate, this idea, these concepts, and make it compliant with this international system. So one of the things that they're talking about here is actually the SEC has to take over. So they want to shift power back to the SEC instead of the CFTC. And part of that is because they believe that a number of these assets are securities. Fundamental change here, right? Fundamental change. Now, is this the primary thing that people are arguing about? Not really. Is it something they should argue about? Probably. Because this is a major change, right? And this is also, that would take $4 billion off of the implementation of this act. But fundamentally, the SEC, if you guys have noticed, has been fundamentally kind of stagnant right now. It's not doing much of anything. There are some pretty funny memes going around saying, talking about what is the SEC doing right now, because it's just dropping charges all over the place, right? Just dropped one against Gemini, I think. And what is it actually doing right now? And what is it trying to enforce? Is it enforcing anything? And part of the problem is that it's not sure what the law is or what it's going to be, or if it tries to enforce something, if that's just going to be overturned, and that's a waste of resources, right? So right now, post Chevron, right? So for those people who understand that that issue, right? The whole issue of moving away from the agencies having dominance over interpreting regulations and law, especially when there's ambiguity. The SEC is kind of at a loss. All the agencies are, but the SEC is primarily at a loss. And it has this issue right now of, well, if the courts are going to be the ones that say what the interpretation is when there's ambiguity, and the courts haven't actually said what the interpretation is, we don't really know how to interpret this. So there's this kind of gap right now of understanding what they should be doing and how they should be interpreting it. This, the Loper-Bright timeline that we're in right now, which is the post-Chevron period, has created almost an absence of action. And that's not good. Right? They need to figure out how to move forward, even in the absence of information from the courts, right? The courts are not going to act presciently. They can't act ahead of what is going to happen in the world. So the agencies kind of have to act knowing that they may fail at court. But that's not happening. The agencies don't want to fail at court. And that, I think, is really what's kind of stopping things. So just keeping that in mind, we've got kind of this weird situation right now where nobody wants the ball. And that's not good. Okay, so another thing that they want is this the power to demonstrate certification and stuff like that. All of that is right now supposed to be the banking wants that to be in the SEC, and again, that's a big shift. Okay, they want. Let's see, what else are we looking? I've got a lot of notes here also. They also reduced there was a section that carved out a loophole saying basically under 75 million, you don't have to register if you're doing an offering under 75 million. And there they took it out and lowered it to 50 million. I'd prefer it back to 75 million, but the idea of having a loophole is good. Here's why, right? Now, this is the argument that we should have been making but didn't make. There's many arguments that we should have been making besides it's not a security. Here's the problem. The reason that that tokens or something needs to be used to raise funds in blockchain that is different from other industries, right? There isn't really a great way for blockchain to raise funds, because when blockchain goes to VCs, we have what happened in 2017 to 2020, which is the VCs put their modeling in, which is go go raise funds from VCs and, put an MVP out and then build, and then go get revenue as fast as you can and start, just raise more money and sell equity. And that is not how blockchain is built. Blockchain is built very slowly and in public, right? And it requires a large community. And the reason that you need to raise funds with tokens is because you need your community to have a lot of input while you're building. If you get VCs to fund your build, what ends up happening is what happened in 2017 to 2020, which is you end up with black box builds that are off chain with a Web3 wallet. That is not safe, and that's not even blockchain. Right? For a true blockchain build, you need it to be a long, slow build in public, and it doesn't generate any revenue for years. There's no way to get revenue without doing some sort of sale to your community and having them be part of the build. There isn't a way to build blockchain. This is a unique technology that requires it. So you need to have some sort of exclusion that permits this. Otherwise, you invite scams. It's a requirement. You must actually have some way to sell. So this is actually one of the arguments that we should have been making, which is the way that VCs and other industries operate. A small group of people having equity interest in a company that then goes public is not the way this technology is built or grows. That makes, with fast iterations and pivots, that works. Blockchain can't pivot easily. It took 7 years from the time Vitalik said, I want to be proof of stake, for proof of stake to actually happen. 7 years. That's not pivotable, right? This is not a pivotable technology. That's a big issue, right? So we have to think about the fact that when you have something that doesn't pivot well because of immutability, you have to have something that has a lot of input and is not going to be finalized for quite a long time. It can't go public for quite a long time. You have no mainnet for a very long time. So you have to have a way to raise funds and bring people in so that you can support yourself while you're building this thing. So there is a requirement to have this ability to do something that is fundamentally capital raising, but it should have a lot of clarity in what is being done with the funds, who the funds are being raised from, who has access to those funds, etc. Right? So there should be a lot of information about this, but the fact that blockchain requires this should lead to an exclusion, right? This is a different kind of technology. Okay, I'm moving on from that. I don't want to spend a billion hours on that, but that is something that is a mandatory thing that we're not actually discussing enough. Okay, the second thing, the protection against illicit finance, is another whole area. And this one deals with a thing called digital asset kiosks. This is basically like those, Bitcoin terminals and stuff like that. They want a lot of KYC AML at those terminals. Good luck is all I have to say about that. That's going to be a crazy thing to try and implement. I don't really know how they're going to be doing that. You can basically say, put ID or whatever in, but a lot of those terminals work the way that they work, and trying to retroactively put in information in those terminals. Most of those terminals aren't even in the US. So, good luck. So the next part of this is about DeFi. DeFi is a big area, right? And this one wants a lot of record keeping and control over DeFi. Now, this is a big problem, right? They want so one part of it is cybersecurity standards. That's not necessarily a bad thing, right? We need cybersecurity standards on DEXs and stuff like that. But we have to say, is cybersecurity really the issue in DEXs? They want NIST standards and stuff like that. In DeFi, are we having a lot of problem with cybersecurity, Or is the hacking primarily from insiders? So I think that if you look at it, you're not going to see that a lot of these things are being hacked because they're being poorly built. I think what you're going to find is a lot of them are hiring people who don't know. And then they have insiders who are coming in and stealing, right? Or you have some hackers who are coming in who are part of the system. And that's a very different problem. Cybersecurity can't necessarily take care of that. That's more of a systems problem, right? So when you're building, you have to make sure that the people that you're building with have some sort of skin in the game where if there is a theft, they're the ones who are on the loop as well, are on the hook as well. But there's another set of indemnification here, like another set of amendments that are saying, oh, all the software developers are not on the hook for any of these regulations. They should be on the hook, not for regulations, but they should be on the hook for inside damage. Right? So that's a separate issue. They have to look and see where are the problems, not just where do they assume the problems are coming from, because it's not usually poor builds that are the problem, right? That's not usually the problem. Okay. The other part of this is making sure that they can have a temporary hold. They want Treasury to have a temporary hold from 30 to 150 days on transactions in DeFi. What? No, that's not possible. That is essentially like any exchange being able to say you can have a temporary hold on particular assets or particular transactions from 30 to 150 days. They want to have clawbacks, basically, that Treasury agents can come in. So first, they need to have Treasury agents being able to identify and access these things. And second, they want to be able to claw them back. Huh? Okay. So this part, again, which the exchanges are not complaining about, but everyone should be complaining about this. This is fundamentally the same thing as a robber has a briefcase full of cash, and then the government says, okay, no more transactions in cash because some of that cash could have been the cash that the robber had. No way. That's fundamentally wrong. We do not want to deal. That's not okay. You can't stop all transactions because some of it might be flawed, right? Or some of it might be tainted. Not okay. So what we want to do is, that part I think is fundamentally, I don't even know how that's going to work out. What we need to do is something like, look, if you want KYC AML, at the point of entry, where someone is changing between, fiat to crypto, right? At some point, there's always that change. You want KYC AML there, okay? But then it's your job to track the train, right? It's your job to see where those transactions are. You can't stop everyone else's financial transactions just so that you get to like fix whatever it is like that. No way. Are you kidding me? You don't get to stop everyone else's financial transactions to do that. So, and you don't get to stop anyone's financial transactions to do that. You don't get a hold what if they're wrong? What if they put a hold on those transactions and they're wrong? Like, all of that kind of power is the kind of stuff that makes me leery. I don't want the Treasury Department to have like a super hold on DEXs or something like that. That's what they want, essentially. All of that is fundamentally problematic, right? They're allowed to get taxes, right? They're allowed to get payments from benefits that we receive, but to have essentially the right to stop transactions from happening. That is why CBDCs were fought against, right? Which is, stopping the ability to do this, stopping the, I got to turn off comments. I can't look at comments. I appreciate everybody with the comments. I'm just going to look at something else really quickly because I can't read and talk at the same time. So that's fundamentally why we we have decentralized anything, right? We don't need the government pre-approving whether or not a transaction should go through, or having the ability to stop a transaction from going through, right? We can't have that. Okay, so the next part of this is the responsible banking innovation, which is essentially saying that digital asset service providers may not pay any form of interest or yield solely for holding stablecoin balances consistent with the Genius Act. A whole other issue, right? I have a whole other thing on the Genius Act. Again, if you want to hear the breakdown of the Genius Act, I think I have that on X also, but maybe I'll do another one here on LinkedIn. But the Genius Act is super problematic, but consistent with the Genius Act. The amendment says that the prohibition doesn't apply to activity-based reward or incentives, including consideration, reward, or benefit in connection with a transaction, a wallet, protocol, participation in loyalty or incentive programs, or liquidity, governance, validation, staking, or ecosystem participation. Why is this a problem? Who hates this? Two people, right? Two people weirdly in bed with each other. Okay. Banks hate it. Number one, so you can see it behind the microphone. Banks hate it. And who else hates it? Exchanges, especially Coinbase. Coinbase leading the charge on this one. Why do they hate it? Why do they hate it more than they hate this other stuff that I think is way more egregious? Okay. First, banks love the current stable coins, right? Banks love the current stable coins. Why do they love the current stable coins? They love them because they love that the stable coins can't pay out yield. They can't, according to the Genius Act. Stable coins must sit. How do you get yield from stable coins? You got to do something with them, right? So banks using stable coins right now, let them sit in deposit. They don't do anything. Do the banks use those stable coins to do anything? No. Banks are using deposit coins. Like they're actually a different type of coin, a different type of crypto that actually is the face value of your deposit, right? So whatever you have in your deposit, they use a different type of token that actually represents the face value of it, and that is what actually transmits through the system. That is why the Genius Act creates inflation. Separate whole issue, but the Genius Act creates a growing amount of inflation. Right now, it's up to like $260 million, but it's just growing at an increasing rate. But those stable coins literally sit and do nothing. Why do they even have them? Because they don't want to pay you any interest. I'm keeping them in stable coins. I'd love to pay you interest, but I can't. I'm not allowed. Oops. Okay, that's what banks do. Now, why is this a problem why is this a problem now for the exchanges? Well, let's look at Coinbase's numbers. So Coinbase, right, makes a ton of money from its stable coins sitting there. So stable coins that earn revenue outside of the banking system, right? So right now we have 3 years to be compliant with the Genius Act. So there's a bunch of stable coins out there, USDC, Tether, whatever, that earn money just sitting there, right? And the stable coins that earn money, the banks are mad at that, because anybody who understands anything about stable coins, those stable coins now leave the system. Right? They leave the banking system and they're like, hey, you give me no interest. Or if I put my money in a savings account, I get like 0.1% interest or something like that. But if I leave the banking system, I can go get like 4%, 7%, whatever it is, right? Because the stable coins will give you a return. So there's money leaving the banking system and going into stable coins that are giving passive yield, right? Hopefully that's clear. Please comment. I'm looking at the comments. Don't worry. Please comment if any of this is unclear. Okay. So now the Coinbase is one of the beneficiaries of this. People let their money sit on stablecoin, right? And they get passive yield. Who else lets money sit and gets passive yield? Coinbase. Coinbase puts a ton of their money in stable coins and lets it just sit, right? It doesn't have risk. It just sits there and it gains a lot of yield. So here, let's see, in Q3 2025, their stablecoin revenue passive, right, was 355 million. So it's a big and growing percentage, and it offsets a lot of the market fluctuation. So it's around like 20% of their revenue or something, but it fluctuates a lot, right? So it's, and their rewards, it generates a huge amount of rewards. So it incentivizes people to come on to Coinbase. So it's not just their, it's not just their reward, but it also incentivizes people to come on to Coinbase and let their money sit, right? Which is, it makes it more likely for them to trade, which is a revenue source for Coinbase, right? A bigger revenue source. So if you let your money sit and generate passive revenue, you're also more likely to trade on Coinbase, right? So that's why they like this, right? So that is, and being able to offer those rewards is a big part of their model. Right, that's a huge part of that. So here it's their stablecoin rewards are $1 billion annually. So someone, where is the passive yield coming from? It's mostly from Coinbase. From USDC, from Circle. They have a partnership with Circle, and that's where most of that passive yield comes from. And so they say that a big part of their, it's going to impact their model. They're not the only ones doing this, right? So this is happening with basically, this is the MO for every exchange, is essentially offering these rewards to make people leave your money on, which, by the way, super unsafe. Please don't park your money on an exchange. It is at risk. They're not going to refund you unless your money is lost during an active trade, which is like less than like a percent of loss, right? So, it's not likely that that's going to happen. They're not going to refund you if something happens to your money on Coinbase. So don't let your money sit in an exchange. It's really not safe. It's actually better for you to put it in a cold storage wallet and actively do something with your stable coin yourself, rather than just let it passively sit. But they don't want you to do that. They want you to let it sit in that hot wallet where it's not safe, but they want you to let it sit there and gain rewards and then trade with them when you feel like trading. Okay, so both Coinbase, right? So Coinbase is really mad because they don't want this to happen. They don't want you to say, they don't want this 3-year window to go away, which is you can't generate passive yield. Now, you have to actively do something. They're like, what the hell? That's how we convince people to stay in our super, super unsafe wallets. Right? That's how we do it. Like, we generate, 16 to 20% of our revenue that way, but also we get $1 billion from people in doing that. So we need to have this. So that's the main reason they walked away. Now, they had some other statements that they had, which was, regulatory capture. The banks are actually trying to ban competition, and it's anti-competitive and whatever. But we know the truth, right? It's always money, and they're going to lose money doing this, right? So what the banks hate is the other part of that, which is you can make money by doing stuff with your stable coin. They don't want anybody to make any money doing anything with stable coins, right? Because they don't want any competition for the dollar. They don't want anything. They want you, basically, if you want to make money if you want to earn revenue, you have to use the traditional finance system. They don't like anything else because they don't get a piece of it, right? And that's the same argument, incidentally, that Coinbase has. They don't want people doing anything where they're not getting a piece of it. So anyway, so that's where we are with that one. Responsible regulatory innovation is basically a prohibition on any person to represent that a tokenized real world asset is itself equal to the underlying real world asset. You can't represent that a tokenized financial instrument is equal to the underlying financial instrument. Okay, but it has to be regulated the same way as that underlying asset or the underlying financial instrument. That's weird. You can't say that the underlying asset is not the same, right? And the underlying instrument is not the same, but I'm going to regulate it the same way. No. You got to pick one or the other, right? You either say, oh, it's not the same, so it doesn't have the same regulation, or you say it's equivalent, right? You can't do both. You can't do both. Unfair, right? Unfair. Anyway, so then they're saying the SEC has to issue rules on security-based swaps, and the CFTC has to issue rules on tokenized financial instruments. Now, the weird thing about this, saying that the tokenized real-world asset is the same as the real-world asset is, are they seriously suggesting that someone with a tokenized, like let's say it's a tokenized, percentage of a building is the same as the underlying building? Do they think people are confused by that? I'm not entirely sure. So I'm not sure what exactly the confusion is here, but I don't think people are confused that the token is the same as the asset, or a tokenized percentage of art is the same as the art. Like if you own a tokenized percentage of the Mona Lisa, you don't own the Mona Lisa. I don't think people are confused by that. I'm not sure, but I'm going to hazard a guess here that it's not the same. All right, a question. Does that include parking your money in a brokerage account like Fidelity, Coinbase? I understand the risk. Oh, hi, Alex and community. Okay, hi. Hey, Chris, great to see you. Okay, parking your money in a brokerage account. So this is the last topic. So does it include parking your money? Oh, like no stable coin yield? So if the question is, does that mean you get no stable coin yield, like parking your money in a brokerage account? So Fidelity isn't offering, to my knowledge, right? Stable coin, if this is about stable coin yield, to my knowledge, Fidelity isn't offering like a stable coin yield, like a brokerage account. So I'm not sure what the question actually pertains to. So if you can clarify, that'd be awesome. Okay. So there's also more in this real world asset section, which is contentious, by the way, because there's a lot of, real world assets are growing. This is actually what our startup is actually dealing with. Our company deals with this. And this is it's a huge area. And the way that this is actually, the way that these amendments and this draft is written is actually problematic for a number of people. But a lot of it is that the real issue really has to be that if you're going to do synthetics, which is basically a tokenized duplicate of something like a stock or something that, which is the financial instrument, or you're going to do a tokenized real world asset or something like that, the real issue is duplicates, right? You must make sure that the synthetic, right, captures whatever it represents, right? So essentially, you don't want the real world and synthetic both trading. You need the synthetic to trade as an alternate to the real world. That is not expressed in here, but that is the real risk of synthetics and tokenized real world assets. It is alternates. And you need to make sure that whatever interest is captured in a token or in an in some synthetic alternate, that the underlying thing that it represents is taken off the market, somehow marked or itemized as something that is represented elsewhere and trading elsewhere. Right? So that's the biggest issue, is that you don't want, let's say you've got a token representing Tesla stock, that underlying Tesla stock has to be captured and removed from the market, because otherwise you've got doubles. And that is the biggest risk, right? Is that people are not properly accounting for the thing that they are representing. That's the problem. If you don't own it and account for it, right, then you are at risk of creating doubles. And the person who's got a real world offline something, that thing can be traded freely. And remember, in stocks, people can make markets of things without the owner, right? You can have a whole OTC trading market of something that has nothing to do with the issuer. So the problem is that you can have, let's say, triplicates of something, unless there is a way to mark that something has a synthetic that's trading alternatively, because you do not need to have things that are multiples that are trading. So hopefully that part's clear. That's not in here, but that is something that needs to be taken care of. Okay, and then protecting software developers and other things. I don't think there's any contention there that people don't want people who are just pushing code. Nobody wants them to be essentially liable for what people are doing with that code, even though that's exactly what happened with Tornado Cash. That's exactly what happened. If we can't figure out how to capture the code, we're going to capture the coders. That's exactly what happened. But now they're saying, no, anybody who's, if you've got a money transmitting business, but you're just the coder for it, you're not going to be liable, right? So this is actually a good thing, that I mean, in a lot of ways, because there's a lot of people who are coding and they're like, I'm just trying to help, or like they're the validators or they're the miners or something like that. And those are not the people that you're trying to go after. In any case, okay. What is next for this kind of thing? So as I mentioned, we've got another whole set of amendments that are coming. And those are not even bipartisan. So we've got already laid out a whole set of arguments that we know are coming out from the Senate Ag Committee. I don't think this thing is necessarily going to be passed anytime soon. And because there's so much argumentation coming. Now, the White House is pushing for something. Do they know what they're pushing for? I don't know. Is there an outcome that they're looking for? I don't know. Right? I don't know that there's a particular outcome that they're reaching for. Is there a champion of like pure blockchain, or at least making sure that tokens stay, like transmittable, right? Like that DeFi is DeFi, that we can have some sort of fair mix between making sure that we catch criminals, but still allow transactions to happen without making the people in the transaction knowable. Like there has to be a knowable unknown. You don't need to have people in a transaction known to one another, right? Unless something goes wrong, in which case the parties should become known to one another. So there has to be a way to make identities knowable to one another, but you don't have to know them at the time of the transaction. When I'm buying something, like I'm buying a shirt from a store, the people at the store don't need to know who I am, or what I do, or my phone number, or whatever. They try to get all that information from you, but they don't need to know any of that information. They want marketing information. They want all this information. They're not entitled to any of it, right? All they need to know is, do I have enough money for the shirt? That's it, right? That's it. So that's really all we need in transactions, and we have to get back to pure transactions. However, if I pass a bad check, or I have a stolen credit card, then they are entitled to know who I am, because they're entitled to go after me. That is the system that we need to go to, right? And that is the same system that we need to go to for blockchain. So is that where we're headed? I'm not sure right now. Before I saw how contentious the ag amendments were, I thought maybe we had a shot if they fix this, but I don't really even see the exchanges coming back to the table. So this is kind of, I think we're just kind of sitting right now, and it might be a little bit before we even get some, we'll get some new amendments probably at the end of the month. And then from the response to that, from the amendments and the response to that, I think we'll be able to see where we are from there. So any final questions on this? How does it impact you? I hope I actually covered how this impacts you. If you're a builder or investor or anything like that, a lot of this is going to impact you. The way that this develops is absolutely, going to impact your ability to build and your ability to invest in blockchain. The stablecoin real world asset, and what investor or what agency is governing. All of those are the key issues you want to be looking out for. And I really don't want to spend $4 billion for a new agency. Honestly, who wants to do that? We don't have that money. So who wants to spend that? I don't think people realize that the CFTC, creating a giant CFTC, is not the answer to making this all easy and making it all like, suddenly such a, it's going to be so easy to build and everyone's going to want to use it. That's not the answer. So anyway, okay. Wonderful to see everyone here. And I don't even know, like I don't know if anybody else has any questions or anything like that. Or any other comments. And I don't even know how to find out how many people are here. So hopefully I'll find out, or someone else can tell me, because apparently you guys can find out. But because other people are like, oh, this is nice, a nice turnout or whatever. But anyway, this was fun. And I hope that you guys enjoyed it and learned. I don't want to take up more time. Oh, a single question. Why is the world not having a single regulation? Oh, like one uniform regulation. Interesting. Because we don't get along that way. We just don't. That is not how the world works. We have organizations to try and get together, but we don't see eye to eye on how money flows. We don't see eye to eye on who should regulate. We don't see eye to eye on how on who should whose rules should apply. We don't see eye to eye on how much information agencies from different countries should talk to each other. So we don't trust each other enough to have one giant regulatory scheme, unfortunately. So we don't want to share bank information with one another. We don't want to share, money flows with one another. And that's a big problem. Like people don't trust each other enough. And that's regulatory information. Even in the US, right? Agencies don't like sharing information with one another. So I think that's the biggest problem, is that regulatory schemes require a lot of information flow and trust. And there's just not enough countries that trust each other enough to do that. So there you go. That's my take on it. Okay, I'll do another one of these. I hope that it was interesting and you guys got something out of it. As always, contact me if you have any questions or you need something explained. This was my first live stream, so I hope it was useful and it came out well. And I will see you guys again for the next one. If you have any comments on what you think I should talk about next, I'm usually talking about economics, markets, and their impact on the like news and law and regulation, and the impact on stock, bond, and crypto markets. So that's usually what I talk about. So if you have any thoughts on what you want me to talk about, let me know. I'll talk to you soon. Take care, everyone. Bye.